We get onto your markets now. Asian markets were mixed at the close, but Chinese and Hong Kong markets continued their rally following stimulus intervention from the People's Bank of China and a fiscal injection of over $100 billion. The Nikkei share average ended the session down 0.19%. The Hang Seng Index closed up 0.7%, while the Shanghai Composite Index rose by 1.16%. US markets ended the session in the black, with the Dow and S&P 500 hitting intraday all-time highs. Tech stocks were also on positive form, with the Nvidia stock price rising by nearly 4%. However, data out on consumer confidence showed the biggest one-month decline in that gauge in more than 3 years, while JP Morgan warned about geopolitical instability and how things appear to be getting worse, raising caution. The Dow Jones Industrial Average rose by 0.15%. The S&P 500 closed up 0.33%, while the Nasdaq Composite Index ended the session up by 0.14%. And because yesterday was the holiday, we didn't manage to show you that President Ramaphosa was the one who rang the bell at the New York Stock Exchange on Monday, but that did happen. So for more on this, we speak to Shantel Marx, who is the head of research at F&B Wealth and Investments. A very good afternoon to you, Shantel. So the People's Bank of China cut interest rates by 50 basis points in China, of course. And of course, they also cut the reserve requirement ratio, which to my understanding means the amount of money that banks must have, put aside in their reserves. They've reduced that. And then on top of that, there's a fiscal stimulus coming of about $110 billion that will be injected into that economy. How important is this, and how was it received by the markets? And on top of that, it seems as though today people are saying it's not enough.
Yes, so investors have been waiting for strong action from Chinese authorities for quite some time. The stock market has been under a lot of pressure, and as a result, policymakers have been under pressure as well. And this seems like the first step in terms of really ramping up stimulus measures on the monetary policy side, which is the stuff you mentioned first, stuff that the People's Bank of China can do. They've really pushed the needle a little bit because the action that they're taking is much bigger than what they've taken in the past. So overall, it was quite well received by the market, but investors said that the fiscal side needs to come to the party as well. So government itself needs to come to the party as well. And we have seen the beginning of those stimulus measures coming through, as you mentioned as well. But the sense in the market now is that this could be like an adrenaline shot to the Chinese economy and perhaps the Chinese market, but that it does little to address the structural issues in that market. And I don't think that investors are yet comfortable that the property market is out of the woods in China just yet. Yeah. So until there's a plan there, I think investors will remain skeptical.
Somebody sitting at home may be thinking, why are they talking about the Chinese economy and the Chinese economy getting stimulus? How does that affect me? Why is China's economic stability so important, especially for countries like South Africa?
So I think it's threefold. The first thing is China is just an exceptionally large economy. It's the second largest economy in the world. And when it grows and it is strong, then that is really good for global growth and by extension for a small open economy like South Africa as well. Secondly, if China does well, it boosts emerging market sentiment. And of course, South Africa is an emerging market as well. And they will benefit from that boost in sentiment also as it relates to foreign direct investment and the rest. And then finally, China is a very important market for South African products, especially the minerals that we produce. So if China does well and that economy is expanding, then demand for the minerals we produce increases. That means volumes increases that are being exported and the price increases as well.
So now that a global monetary easing cycle appears to have started, what does that mean in terms of investment portfolios? Do they need to be readjusted at all? Because I suppose people will have been putting some cash aside to be able to benefit from the higher interest rate environment. And of course, there was some risk aversion, because of the volatility and so on and so forth, even though markets have been continuing to hit all-time highs.
Yes, so I do think that a lot of portfolios were conservatively balanced over the last few years, especially with big weightings into cash. As you rightly said, interest rates have been quite high. But with interest rates coming down, cash becomes a less competitive asset class, and you need to start looking for returns elsewhere. Lower interest rates generally tend to benefit equity markets the most. I think the question mark now is, where do you see the value? Because we have US equity markets still looking very expensive relative to the rest of the world. I do think it will benefit an equity market like South Africa's equity market, that where even though we have started seeing some improvement in returns over the last few months, it still looks cheap on a relative basis.
Shantel, we're going to leave it there. We've run out of time. That was Shantel Marx. She's the head of equities research at F&B Wealth and Investments.